Welcome everyone to the fifth session already on day one of the Modern Investor Summit. I'm Stefan, a global analyst here at Finimize, and I'm very excited to guide you through this session as we explore the world of alternative assets. So first, a big thank you to our session partners, Victory Hill Capital Partners and Forfi. Victory Hill Capital Partners is a leading investment firm focused on delivering sustainable energy and infrastructure solutions, aiming to drive impact while providing consistent returns. Forfi, under the direction of Chris Ragland, is dedicated to helping investors leverage alternative assets in today's rapidly changing market environment. Now, before we go into the fun stuff, a quick note on housekeeping. If you're just joined us, please introduce yourself in the chat with your name and where you're tuning in from. This session will be a 30-minute panel discussion, but don't worry, we'll have time at the end for some Q&A. So don't forget to submit your questions in the Q&A box below. And joining us today are not one, not two, but three leading experts in alternative assets. Richard Lum, Managing Partner and Co-Chief Investment Officer at Victory Hill Capital Partners, Chris Ragland, Chief Investment Officer at Forfi, and Rob Petrozzo, Co-Founder, Chief Product Officer at Rally. So in this session, we'll cover how alternative assets like renewable energy, healthcare, and collectibles can help diversify portfolio, reduce risks, and of course, help you profit from the opportunities amid evolving economic conditions. So a pretty exciting topic for today. Richard, Chris, Rob, welcome. Pleasure to have you all here. So maybe let's start with you, Chris. Alternative assets sound pretty fancy, but what are they really? And why should everyday investor care about, adding them to their portfolios right now? I think the right now part is also pretty important.
Yeah, sure. Absolutely. I've been in the alternative investment sector for the past 20 years. So for me, it's not necessarily a new part of my portfolio, but I would tell the investor that the alternative asset class in general should always make up some portion of your entire portfolio. Honestly, there's a lot of leading industries, whether we're talking tech or healthcare or green sector or any of these sectors, that are going to count as an alternative investment strategy. Whenever you're looking at these leading industries, they're trying new solutions, they're looking for new ways to innovate, and the result for the investor generally means that they're going to see an outsized return. However, there's another way to look at alternative investments, and that is to essentially be a contrarian or a buffer or something against their core assets. So whenever I'm talking to investors and I say, what is your core investment strategy? Now let's look to the alternative investment class to either look at augmenting your return or providing a buttress against those types of investments. So again, I work specifically in the healthcare space. That's what we're talking about today from my company. But some of the other panelists here, all of us represent wonderfully different and diverse alternative investments.
Thank you so much, Chris. Richard, what's the buzz in sustainable energy? Any golden opportunities retail investors should jump on today?
Good afternoon, Stefan, and thanks a lot for having me. I would just echo, what Chris has said in terms of, why investors should have this as part of their portfolio. From my perspective, and having invested and financed private real asset deals in energy and sustainable energy over most of my career, so I've been doing it now for 30 years. The real interesting element of this and the advent of sustainable energy is the sheer scale of it, the amount of capital that is required in order for us to make that transition to net zero within the energy space. I tend to liken to a second industrial revolution. I think it's been estimated that you need a further $3 trillion of capital infused into energy infrastructure in order to achieve the net zero targets we're aiming to achieve, in 2035. So this is a very interesting area that requires significant amounts of capital. Now, the way that we approach it at Victory Hill, given that we've been managing a listed investment trust that's called VH Global Energy Infrastructure, it's listed on the main board of the stock exchange. What do we offer investors here? Well, we thought and we feel very strongly that the energy transition can only be adequately managed and made an impact in if you approach it from a global perspective. It's a global phenomenon, and you need to invest and deploy in a global perspective, and that's what we offer investors. And if you look at it within that framework, then investors are able to achieve three things by participating in real asset investments in sustainable energy. The first point is diversification. By accessing an investment trust such as the one that we offer, you have exposure to a range of different technologies and different geographies that deal with sustainable energy. Secondly, it offers you a very attractive yield. If you were to approach the transition just purely within the context of highly saturated renewables markets, for example, in the developed world, you may not achieve that. But if you look at it within the context of both developed and emerging parts of the world as well, you can get an attractive yield. And thirdly, we offer investors the potential for growth in their portfolio, because a lot of the real assets that we invest in go from construction into operations, thereby having an uplift in their valuations as we go throughout time. So really having these three core elements and also being able to make a sustainable impact as well as investors participate in this format really is a boon, we believe, for investors to be able to access and make a meaningful impact in sustainable energy.
Super interesting. Thanks, Richard. Rob, collectibles as investments. I mean, spill the tea. What's the deal, and why should we care?
Yeah, I mean, I think that for one, I think Richard just kind of touched on it. The idea of real assets is something very interesting to not just existing investors that have been in the market for a long period of time, but a lot of new retail investors. I think that the markets in general have always kind of leaned on this idea that emotion should be taken out of investing, and that it should be, purely a binary outcome. Investing in collectibles is the opposite. And I think that's kind of the way of the world. I think our mission at Rally has kind of always been turning aspirations into equity. Literally, that's part of the mission statement. And the thought process is that you have the unfair advantage when there's an information asymmetry. And these are asset classes, even in collectibles, that have really been outpacing the market in a lot of cases, but have been kind of the trappings of wealth and have been in the portfolios of the super wealthy for a long time. I think that a lot of people lean on art and real estate as the ones that the alts that have kind of been accepted by mainstream. But we're seeing so many more of these, what we consider collectibles and museum quality stuff, find their way into portfolios of institutions and private equity and the super wealthy. And I think that that's kind of part of what's driven retail interest as well. And emotion becomes that real advantage. So from a retail perspective, I think you have two kind of core beliefs of a retail investor right now that's investing in collectibles. I think one is kind of the obvious one that hasn't been obvious, but it's starting to be more obvious now, is that investing in things that you love kind of gives you that unfair advantage. So there's an information asymmetry for a long time around individual assets that are considered collectibles. When we first started Rally, we started with classic cars, which was an asset class that a lot of wealthy people have been collecting. There was a lot of kind of inside information where you have to kind of know what was available in the market. You have to have a relationship with the seller. As a buyer, you got to have a lot of liquidity and come to the table with a meaningful offer. A lot of times it was done on kind of the back doors at auctions. But what we saw was that when we did our first IPO, it was a 1950s era Porsche, and it had all the rarity specs. It had all the kind of the check marks you would want in an investment, but it was a car. It was really hard to explain why a car was an investment. We did kind of like an IPO roadshow, and what we saw was that we would have 18 or 19-year-olds or 20-year-olds come up to us. They knew everything about this vehicle. They knew more about every aspect of this car, what made it important and what made it valuable, than a 60 or 75-year-old who has 10 of them in their collection. And that's kind of the advantage that a retail investor has when you kind of have that kind of level the playing field and there's still a little bit of alpha there. I think the second part of it, which is probably just as important, is that it's a little bit of a welcome change to invest in collectibles and invest in these alternative assets where it's not necessarily something that has nonstop liquidity. It's not crypto. It's got something real behind it. And I think that from my perspective and a lot of retail perspective, that nonstop 24/7 liquidity is kind of the enemy of rational thought when it comes to investing. So to have something that's a 60-year-old watch or a 160-million-year-old dinosaur fossil, these things that we're starting to see pop up more in auction results and see more in the collections and the portfolios of private equity and of individual billionaires and big sort of whale investors, you have the ability to sort of put your money there, not have to pay attention to it 24 hours a day. It still has those big exits that are available at auction and enough liquidity to kind of make it a real market without having to be a nonstop 24/7 meme coin. I think that's become really interesting to a lot of investors, and that's kind of part of the alpha that's still available in that asset class as well.
Super interesting. Chris, healthcare is getting a lot of love, I would say, in the alt investing world. And I think there is one opportunity you'd like to expand a bit. What's physician lending, and why is it a prescription for investor success?
Sure, thanks. When we talked to, and you just heard from my other fellow panelists, that generally speaking, when you're looking at alternative asset classes, you are looking for an outsized alpha return. You're looking for parts of the portfolio that are not going to be traditionally available from a standard broker house. And that is when you look at what is defining what is an alternative investment. One of the ways I like to define that is if you go to a large broker house and they're not able to put that asset on custody, and they can't sell that asset to you, it's probably an alternative asset. For us in particular, the physician loans are rather interesting. These are business purpose loans that are made to physicians. So we're talking doctors. The case study that I like to provide is maybe a small dentist office, a family practice, and they need a short-term loan to buy some new equipment. That type of specialty finance, generally speaking, is incredibly expensive for the dentist. It's cost prohibitive and doesn't allow them to expand their business like they may need. So for us, we solve that niche problem, right? So when you have a small physician that's looking at either equipment or they're looking at expanding their practice, maybe overhauling their marketing systems, these are the type of short-term loans. However, when you look at physician lending in general, the historic data shows incredibly high performance and very, very low default rates. So this is ironically an alternative product that's very conservative. So it's a conservative product that has a very low historical default rate, which allows us to create an alternative asset class that should be seen as a low risk, steady return. The other part is it plays a role in private credit. When you see a lot of investments in the alternative space, generally they force the capital to be patient. The capital has to wait a long time to realize some type of capital gains. In a private credit space, we're generally matching the, which in this case is a short-term loan, with returns back to the investor. So we can actually create income streams. This is interesting for investors that may be working with a qualified tax account that's looking for an income stream, or perhaps they're looking to augment their portfolio. They have enough of their assets. Now they're trying to figure out how can I create reliable and consistent income. So, the physician loans create an opportunity for us to remain in the alternative asset class and play in private credit at the same time.
Wow. Richard, let's switch gears. The new US administration is shaking things up. What does that mean for investors, and where's the silver lining for alternative investments in particular?
Gosh, what a big question. So, obviously there's going to be a rebranding of, the administration's approach to energy and the idea of sustainable energy. I think the big picture items are fundamentally that, whatever has been implemented under the IRA previously, a lot of that allocation had gone to red states, let's say. So the idea that it would be overhauled in any meaningful way perhaps is a little bit short-sighted. I think that it will subsist in whatever form, in a rebranded form. I think the idea of nearshoring industry to support sustainable energy is here to stay because it has wider implications than just the idea of sustainable energy or not. It is industry. And that's good for us. That's good for investors who want to come into the US to participate in investing in this way. There's clearly some level of questions related to how the idea of heightened tariffs may play in overall renewable value chains, because a lot of the value chain have been concentrated in China, etc. So let's see how that plays out. But I think as an investor looking for opportunities in sustainable energy, not only in the US but globally as well, a couple of things that I would point out that investors should be looking for. Firstly, as a means of implementing investments in sustainable energy, we don't believe in what we call subsidy. A lot of the earlier stage sustainable energy projects and investments and renewable investments heavily depended on subsidy in some form, government tariffs, etc., in order to make those types of projects work. Now, this limits your upside. It limits your ability to get that alpha type of return because you plug into a single subsidy over a 20-year period, you implement the project, And then what do you do next? You try to seek some form of leverage on those projects as well. And of course, as we get into heightened inflationary conditions, such as over the last 18 months or so, the cost of debt goes up, but your revenue streams don't go up, so you get compressed yields, and that's not good for shareholders. The way we tend to implement our investments are looking for essentially liberalized energy markets, striking private contracts with off-takers, with private commercialization streams that don't depend on government subsidy. And I think the US is a very good place for something like that. It offers very liberalized independent power markets throughout the country, where you can trade electrons very visibly. So the idea of having some form of supply-demand imbalance where you can access a particular margin using, for example, battery storage, which is a new phenomenon, really, obviously the greater amount of renewables in the system, if the wind doesn't blow, the sun doesn't shine, you get stuck for the supply of power, the price of power goes up. So if you're able to store that power using battery storage, for example, you're able to access a margin. We are deploying in that type of way in areas such as Australia, for example, that offers us a way to get access to margins, because during the daytime in Australia, there's lots of sun, but at the peak times in the mornings and the evenings, there is insufficient energy. So having battery storage there helps out a lot and allows investors to get access. In the UK and Western Europe, similar type of phenomenon, and indeed in the US as well. So investors need to understand the way that deployments into sustainable energy are evident. You need to move away from subsidy-based types of contracts and look for commercial types of arrangements, have limited amounts of debt in there if possible, and also look for liberalized energy markets. These are what we look for in our investments.
Rob, out of everything, but hopefully still linked to collectibles, what's the one investment opportunity that's got you the most hyped right now?
Yeah, I mean, right now we're in this moment, I think, where a lot of what were considered the boring investments in the past are starting to have a little bit of a moment right now. So these are things like first edition literature, everything from historical documents. I think I put dinosaur skeletons in there. I think for us right now, like, we've been so focused on the one of ones, on the things that you really can't get your hands on, that have a long history of returns. Those are the ones that are kind of in the spotlight right now. We have a $13 million Stegosaurus skeleton that we're IPOing later this month, and that's gotten more institutional interest than any offering in the history of our company, going on 6 years now and over 420 assets. I think there's a reason for that. I think it's one of those the same kind of situation where you see private equity going after these kind of generational businesses and the legacy businesses and the things that kind of have printed money and can be bought at low multiples right now relative to the market are the interesting things to even retail investors on our platform and in collectibles in general. I think it's proven. It's something that's kind of lasted time. I think when you think about something like a dinosaur fossil, for example, it's something that's 160, 170 million years old. We've learned about it starting in kindergarten. It stays relevant throughout the course of your entire life, from learning about it at an early age, seeing it in pop culture and then entertainment, all the way to now. When you think about geopolitics and even renewable energy, it's something that the idea of dinosaurs, fossils, what's in the ground, the things that are going to kind of fuel the future, literally and figuratively, are the things that are on the minds of investors on our platform right now and in collectibles in general. So those are the things that I'm looking at, where they check the boxes. They have to have that rarity. They have to look like something that should be in a museum. And I think that more often than not, they're the things that are relevant now and will be relevant in the future, are the things that we continue to look at and that I continue to look at personally in my investments as well.
Super cool. Thanks a lot, Rob. Okay, so now let's move on to the Q&A. So I guess let's start with you, Chris. A question for you. Why is it important for investors to diversify into niche markets like physician loans, for example, and what role does this play in portfolio strategy? What are the barriers to access these markets?
Yeah, generally speaking, I'd say the largest benefit is just diversification, right? Whether that means you're looking for, outsized yield or a different type of performance return, like, for example, in private credit, and you're looking for that, steady income, for example, on us, or maybe in a more asset-based class, like you see that Richard and Rob are talking about. It could be for something that is completely non-correlated with the market that's still receiving long-term capital gains. Those are the big reasons why you want to focus on the alternative investments. The accessibility, though, can be a large challenge for many investors. You have to work, generally speaking, directly with the sponsor or with a company that has access to several of these types of investments. So it does require a little bit more of due diligence and sophistication on behalf of the investor. And then there may be some type of, depending on where you're domiciled, if you're in the US or if you're in other countries, there could also be some restrictions. So you're going to look for what is the pathway for me to invest. If I'm speaking to accredited investors, generally that's going to check the box and you're going to be able to participate. If you're more of a retail investor and you're not that accredited level, it could be more challenging in the alternative investment class in general. So those are generally the barriers to entry that you see as well.
Thanks, Chris. Next one's for Richard. What percentage of our total portfolios should we have in alts, assuming we have a long-term time horizon? And I think here, you can answer specifically maybe for, let's say I want to invest in sustainable energy. What percentage should I be looking to allocate?
Yeah, look, I mean, that's a very interesting question. It depends what you're solving for ultimately. I think what sustainable energy investments, particularly as it relates to infrastructure, offers investors is that long-term visibility of yield. Generally speaking, the revenue sources are pretty visible over the long term. We're talking about 15, 20 years or so. The opportunity set to deploy at scale in this is pretty significant as well. And there may well be, depending upon how you bake it, some level of growth element in it as well. That's what we do in our listed trust. There's always a growth element in there. We advertise that there's a 10% net of leverage return on the target on that portfolio. Currently 36 assets there, and it's growing. So that's the way that we would look in terms of yield. But however, if you're going to go all out for growth, then I would temper that in any given portfolio, specifically looking at sustainable energy. You probably have something along the mix of, say, 60 to 70% of infrastructure, like allocation, and about 30-40% type of growth allocation in that portfolio as well. That would give you a widespread, engagement with, the visibility of long-term revenue contracts, etc., but also the ability to get that pop from the developer premiums as you develop projects, and those investments, get a multiple on the development cost initially put in. So that's the type of allocation I would have. I think what's more interesting from our perspective as well is the allocation should be global. We very much believe that the opportunity set is to look at deploying on a global basis, because that's really where you're going to find those types of opportunities. And of course, it matters the type of manager that you would go with that manages that strategy. They need to have a background in transacting cross-border and understanding where those opportunity sets are and what type of energy markets they're interacting with, because they're all pretty much different across the world. So that's really my thoughts.
Thanks a lot, Richard. Rob, what items are classified as collectibles? I guess outside of dinosaur skeletons and a few other fun ones.
Yeah, I think that when we look at collectibles, the idea is that it has to have obviously provenance, has to have rarity, has to have something that kind of makes you feel an emotional connection to it. It could be anything. The problem is that when everything is a collectible, it's the 0.1%, likely less in some situations, are the ones that are the most valuable, that will gain value. And inevitably what happens is when you're a collector of anything, when you first start that journey, you're going to buy what you know, and it's always wrong the first few times. So whether it's a baseball card or whether it's something that's a little bit more high end and it's something that's a little bit more niche, the idea is that you buy what you love over time. If that makes money, that's great. But when you start getting into kind of the investment piece, you want those true one-of-ones. You want pieces that are going to find their way back to auction. You want things that haven't sold in a longer period of time. You want things that have a story behind it. So the most active collectibles on our platform, on Rally to this point, have been in kind of the sports memorabilia space. A lot of times game-worn things from legendary players like Michael Jordan or Kobe Bryant. Those are the things that kind of elicit the biggest response from the biggest group, but they're also the ones that the population stays relatively low compared to the market for other players of that same caliber. So when we could do something, or we can find something that has a great story behind it, is a one of very few, and is the most pristine version or example of a product or a piece that was from the past and has a little bit of nostalgia that drives it, that's a collectible. So now on Rally, with 28 different categories of investments in collectibles, we look at domain names as a collectible too. It's something that represents the first real estate on the internet, and the .com domain, the URL extension of it, is still the most important, most popular space for you to put that internet real estate. It represents this era when the internet took over our lives, and it led to where we are right now. So while that's an intangible, it's still considered a collectible. And for us, having that 3 or 4 letter domain in a portfolio is almost as important as having exposure to some kind of tech or to individual assets and equities that are on widely traded markets. So we think about everything, and I think about everything as a potential collectible, but narrowing it down to the most important examples of the things that are ubiquitous in our everyday life are what bring those collectibles value and kind of bring them to life to the individuals on retail side and on the institutional side as well.
Rob, a very practical questions. Actually, Chris, sorry. I think let's go to you. How do newbie investors get into this kind of alternative investment? So, like physician lending. Like, can you just walk us through? Let's say I want to do it. What are the next steps? How long will it take? How much capital do I need? Like, super practical.
Yeah, so I think with every alternative investment, it's going to be different. I'll use ForFi as an example. It's actually quite simple. For us, you go to a website. So it's forfifund.com, and you're able to book an appointment right there. You can do it over the phone. You can set a specific time, and you book that appointment. This is an important part of the process on our side. So as alternative investment managers, we have to go through a KYC, a know your customer process, and make sure that you're suitable for the investment. And that's generally a few questions, right? So for us, and for example, at ForFi, we're only taking accredited investors. So a big part of our process is to interview you and make sure that you're an accredited investor. And that's a very simple conversation that we can have. And then we onboard you. So what does that mean? You're probably going to see some type of a document first that you're going to review. This is all of the the investment guidelines, if you will. So for us, it's actually a fund. So you're going to get what's called a private placement memorandum and a subscription agreement, right? So you're going to join for a predefined period of time for a specific amount of money that's going to generate this level of income. And that's really nice for you. So as an investor, you're able to actually plan out this type of an investment and the income that it's going to create. And then you get the wire information that gets verified, and then you submit your funds, and congratulations, you're now a member of the fund and you're generating that type of a return. Every alternative investment is, generally speaking, going to be different, right? So that's an important part of the process for the investor, is to go through and make sure that you as the investor are comfortable with the manager of that specific strategy. Ask difficult questions. What happens when things go wrong? What can happen to me? When could I not receive my capital? Is there a lockup period? What's the redemption process for my capital? When you see assets that are tangible assets, that can be a longer period of time. When you see things that are more private credit, that's going to have a quicker turnover rate because there's more liquidity and you're able to get your money back. So asking these tangible questions from the person who's managing that strategy is going to be very, very important for you.
Thanks, Chris. Richard, the next question is, are all of these opportunities only open to accredited investors? And maybe, I will let everyone answer, but maybe we can just start with you, and maybe, you can also address why, you're potentially, closing the gap with those professional investors, and what's the opportunity for retail investors?
Yeah, look, I mean, we set out with the listed trust on the main board, London Stock Exchange, with the intention really of crowding in not only institutional investors, but also offering retail investors the ability to participate in the transition within the global context. We realized at that point in time that quite a few of the products that were listed were very much either focused on a single technology, whether that's wind or a solar, for example, or just a combination of those two, and situated either in investing just in the UK or just in Western Europe. And I think what we came to the market with was a product that said, hey guys, the transition is a global phenomena. If you want to participate in the global energy transition as an investor, whether it's institutional or retail, and more importantly to retail investors, be able to make an impact and also get a form of differentiated return as well. Here is a product that would offer that for you. We had designed it in a way where we had diversification of the asset base. I mentioned earlier, there are currently 36 individual assets across different technologies, across parts of Western Europe, the UK, North America, Brazil, and Australia currently, and that's a pretty global type of format. We manage all of those from Victory's perspective. That offers investors the ability really to meaningfully interact with the transition in a global format.
This was such an interesting session. Honestly, I think we really covered a lot of very different investment opportunities. I know I will certainly look a little bit deeper into some of those opportunities to add to my own portfolio, and I'm sure a lot of the people tuning in will do the same. Thank you so much for your insights. This was extremely interesting. I hope you've all enjoyed it and took something away from the session. But don't go anywhere, as coming up next is investing in AI opportunities in pre-IPO and private markets, and that starts in about 15 minutes. So see you very soon and have a great day.